The most dangerous moment in investing comes when you finally need the money. You've spent decades building, saving, compounding, watching numbers grow in accounts you rarely touched. And then one day, the paycheck stops. The direct deposit ends. And you're standing at the edge of your nest egg, wondering how to extract a lifetime of income without destroying what took a lifetime to build. Warren Buffett understood this tension better than almost anyone who ever lived, not because he needed to live off dividends himself, but because he spent 70 years studying what happens when capital meets human need. And what he discovered was this: the investors who sleep well in retirement aren't the ones with the highest returns. They're the ones who built portfolios that pay them to do nothing. Before we go further, let's be clear about what this is and what it isn't. This is educational content, a philosophical exploration of one man's approach to dividends, compounding, and capital preservation. This is not financial advice. I'm not your advisor. I don't know your situation, your risk tolerance, or what keeps you up at night. What I do know is that Buffett's principles have survived every market crash, every recession, and every moment of panic since 1956. And that's worth understanding. So here's the question we're really asking: can you structure a retirement where your investments feed you indefinitely, where you never have to sell in a downturn, where the principal remains untouched and growing, allowing you to pass something meaningful forward while living with dignity today? Buffett's answer was yes, but not the way most people think. Let's start with what Buffett didn't do. He didn't chase the highest yielding stocks. He didn't build a portfolio of monthly dividend payers just because the income felt good. He didn't buy anything simply because it distributed cash. In fact, for most of his career, Buffett actively avoided high-dividend stocks. Berkshire Hathaway itself has never paid a dividend, a fact that confuses people who think Buffett is some kind of income investing guru. But here's what people miss. Buffett wasn't against dividends. He was against stupidity. And for him, stupidity meant paying out cash when that cash could compound at higher rates inside the business. Think about that for a second. If you own a piece of a company that can reinvest earnings at 15 or 20% returns, why would you want them to send you that cash so you can reinvest it at 8% somewhere else? You wouldn't. The math doesn't work. The logic doesn't work. You'd be sabotaging your own compounding. But here's the paradox that matters for retirees. Buffett loved businesses that threw off enormous amounts of free cash flow. He wanted companies that generated more money than they could intelligently deploy. And when those companies reached maturity, when growth slowed and reinvestment opportunities dried up, he wanted them to pay dividends, not because dividends are magical, but because they represent something deeper, proof that a business generates real money, not accounting fiction. So Buffett's dividend philosophy wasn't about yield, it was about sustainability, cash flow, quality. Businesses so strong they could pay you year after year, recession after recession, without ever compromising their core operations. That's the first principle, and it changes everything. Dividends aren't a strategy. They're a symptom of owning exceptional businesses. By the time you're 60, the margin for error is gone. That's not pessimism, it's arithmetic. If you're 30 and you lose half your portfolio in a crash, you have decades to recover. You can work longer, save more, ride the market back up. But at 65, with 15 or 20 good years ahead, a 50% drawdown isn't just painful. It's existential. It changes what you can spend, where you can live, what you can leave behind. This is why Buffett's approach matters so much for retirees, because his method wasn't built on luck or market timing. It was built on permanence, on owning businesses that could survive anything. He once said something that should be carved into the brain of every person approaching retirement. Rule number 1, never lose money. Rule number 2, never forget rule number 1. People laugh when they hear that. They think it's cute, clever. But Buffett wasn't joking. He meant it with every fiber of his being, because losing money isn't just about the dollars. It's about the time you can't recover. It's about the compounding you'll never get back. It's about the stress that keeps you awake at 3 in the morning, wondering if you'll run out before you run out of life. So when Buffett built his portfolio, and when he advised others, his first priority was always protection. Not performance, protection. And here's how that translated into dividends. He wanted businesses with competitive moats so wide that no competitor could cross them. He wanted companies with pricing power so they could raise prices with inflation without losing customers. He wanted management teams that allocated capital intelligently, that didn't waste money on empire building or foolish acquisitions. And he wanted businesses that generated cash flow so predictable you could set your calendar by it. Coca-Cola, American Express, Johnson & Johnson. These weren't growth stocks when Buffett bought them. They were compounding machines, businesses that generated billions in free cash flow every year and returned much of it to shareholders through dividends. And here's what made them perfect for a retirement income strategy. They didn't need perfect market conditions to pay you. They paid in 2008. They paid in 2020. They paid through wars, recessions, pandemics, and political chaos because their business models weren't fragile. They were fortresses. Let's get practical for a moment. If you're building a retirement portfolio designed to pay you dividends without touching a principal, you need to understand what you're actually building. You're not building a collection of stocks. You're building a private pension, a system that sends you cash every quarter, regardless of what the market does, regardless of how you feel, regardless of whether CNBC is screaming about the end of the world. Buffett's version of this system had a few non-negotiable elements. First, quality over yield. Always. A stock yielding 8% probably has problems. Maybe the dividend isn't sustainable. Maybe the business is in decline. Maybe management is desperate to keep investors happy. A high yield is often a warning sign, not a gift. Buffett preferred companies with lower yields, 2 or 3%, but with decades of dividend growth. Because a 3% yield that grows 7% per year will eventually eclipse the 8% yield that never moves. Second, diversification, but not over-diversification. Buffett famously said that diversification is protection against ignorance. If you really understand 5 or 6 great businesses, you don't need 30. Most retirees don't need 40 stocks. They need 8 or 10 rock-solid cash-generating companies across different sectors, enough to protect against catastrophe. Not so many that you lose track of what you own. Third, focus on free cash flow, not just earnings. Earnings are an accounting concept. Free cash flow is money you can spend. A company can show earnings growth while burning cash, issuing debt, selling assets, playing games with the numbers. Buffett wanted businesses that generated more cash than they consumed, because that excess cash was what funded the dividend. And if the cash kept growing, the dividend kept growing. Fourth, reinvestment discipline. Here's where most people stumble. They take the dividends and spend them immediately. But in the early years of retirement, when you're healthy, active, and expenses are lower, you should be reinvesting those dividends. Let them buy more shares. Let the compounding accelerate. Then, as you age and expenses rise, the income naturally rises with you. This is the Buffett way. Patient accumulation in the beginning, reliable income in the end. Let me tell you a story that captures this perfectly. In the 1980s, Buffett started buying Coca-Cola, not because it was cheap. It wasn't. Not because it was exciting. Selling sugar water is about as boring as it gets. He bought it because Coca-Cola had something no one else had, a brand so powerful that people on every continent would pay a premium for colored carbonated water. And that brand threw off rivers of cash. Buffett invested $1.3 billion into Coca-Cola between 1988 and 1989. By the mid-1990s, the position was worth more than $13 billion. But here's the important part for retirees. Coca-Cola paid dividends the entire time, and those dividends grew every single year. In the first year, Buffett's position earned about $75 million in dividends. By 2022, that same position, no new money added, was earning $640 million per year in dividends. $640 million. From an investment that originally cost $1.3 billion. That's a yield on cost of nearly 50%. And he never sold a share. The principal kept compounding. The income kept rising, and Berkshire Hathaway could use that cash flow to fund operations, buy more businesses, or just hold it in reserve for opportunities. This is the magic of a dividend growth strategy done correctly. The yield doesn't matter at first. The growth matters, and over decades, that growth turns modest income into life-changing cash flow. Now imagine doing that on a smaller scale. Imagine you retired in 1995 with $500,000 invested in a portfolio of quality dividend growers. Imagine you reinvested every dividend for the first 10 years, then started living off the income in 2005. By 2023, your income would have tripled, maybe quadrupled, and you'd still own the same shares. The principal would be untouched. Actually, it would have grown. That's not speculation. That's history. That's what happened to people who followed this approach. Here's the truth no one wants to hear. The hardest part of living off dividends isn't picking the stocks. It's enduring the crashes. Because here's what happens. You build your portfolio. You sleep well for a few years. The dividends roll in. Life feels stable. And then the market drops 30%, maybe 40, maybe 50. Your account balance gets cut in half. Your neighbors are panicking. Your brother-in-law is telling you to sell everything. The financial news is apocalyptic. And you're sitting there watching your nest egg shrink, wondering if you made a terrible mistake. This is the moment that separates retirees who make it from retirees who don't. Buffett's genius was understanding that market prices are just opinions, often hysterical opinions. But dividends are facts. If you own Procter & Gamble and the stock drops 40%, that's painful to watch. But if Procter & Gamble keeps paying its dividend, and it did through 2008, through 2020, through every crisis of the last century, then nothing fundamental has changed. You're still getting paid. Your income hasn't dropped. Your standard of living is intact. The stock price is just noise. Buffett learned this during the 1970s, one of the worst decades in stock market history. Inflation ravaged the economy. The Dow went nowhere for a decade, Investors were depressed, defeated, but the great businesses kept paying dividends. They kept raising dividends because they weren't dependent on investor sentiment. They were dependent on selling products people needed. So here's what Buffett would tell a retiree terrified by a market crash. Stop looking at your account balance. Look at your dividend income. If the income is stable, or better yet, growing, you're fine. The price is irrelevant as long as you're not forced to sell. This is why you never touch the principal. Because the moment you start selling shares to fund living expenses, you're at the mercy of market timing. You might be forced to sell at the bottom, locking in losses you can never recover. But if you live purely off dividends, you can ignore the market entirely. The chaos becomes background noise. Survival beats brilliance. Let's talk about what this actually looks like in practice. The structure of a Buffett-style dividend portfolio for retirement. You'd want a core of consumer staples. These are boring businesses, unexciting, but they print money. Companies like Procter & Gamble, Colgate-Palmolive, Kimberly-Clark. People buy toothpaste in booms and recessions. They buy toilet paper and soap and shampoo regardless of what the economy is doing. These businesses generate steady cash flow and steady dividends. They're your foundation. Next, you'd want financial companies, but only the best ones. Buffett loved banks and insurers, but he was ruthlessly selective. He wanted banks with conservative lending practices, strong capital ratios, and management teams that didn't take stupid risks. American Express was a favorite because it combined financial services with a powerful brand. Wells Fargo was a core holding for years because of its efficiency and deposit base. You need financial exposure because these companies benefit from the entire economy's growth. But you can't afford to own the reckless ones. Then you'd add healthcare, another sector where demand never disappears. Johnson & Johnson is the classic example. A company that sells everything from Band-Aids to cancer drugs. People need health care when they're young. They need it more when they're old. And in a country where the population is aging, health care businesses with strong cash flow and dividend histories are essential. Finally, you'd sprinkle in some technology, but only the mature cash-generating kind. Buffett was late to tech, but when he finally bought Apple, he bought it for the right reasons. Not because it was innovative, because it had a fortress balance sheet, massive free cash flow, and a shareholder-friendly management team that returned billions through dividends and buybacks. The innovation was nice. The cash flow was essential. That's the blueprint. Boring, predictable businesses in sectors with inelastic demand. Companies that generate more cash than they can intelligently spend. Management teams that respect shareholders. You don't need to be clever. You need to be disciplined. But here's where most people fail, and it has nothing to do with stocks. They fail because they can't handle their own emotions. Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." And nowhere is that more true than in retirement. Because retirement isn't a 20-year project anymore. It might be a 30 or 40-year project. You might spend as many years in retirement as you spent working. And over that timeline, you'll live through multiple bear markets, multiple recessions, multiple moments of sheer terror. The investors who succeed are the ones who can sit still, who can watch their neighbors panic sell at the bottom and do nothing, who can ignore the fear and the greed and the noise and just keep collecting their dividends. This is harder than it sounds because fear is real. The anxiety is real. The temptation to do something, anything, is overwhelming when you're watching your wealth evaporate on a screen. But doing nothing is often the most profitable decision you'll ever make. Buffett understood this at a molecular level. He built his entire investment approach around eliminating the need to make decisions during crises. If you own the right businesses and you're living off dividends, you never have to sell. You never have to time the market. You never have to guess when things will recover. You just keep collecting your cash and living your life. That's freedom, real freedom. Not the kind of freedom that comes from having a big number in an account, but the freedom that comes from knowing that number doesn't have to shrink for you to eat, to travel, to help your kids, to sleep at night. Let's pause and talk about the elephant in the room, taxes. Because dividends are taxed. In most cases, qualified dividends are taxed at 15 or 20% at the federal level, depending on your income. And that's before state taxes. So yes, living off dividends means paying taxes every year. There's no way around it. But here's what Buffett understood. Taxes are the price of success. If you're paying taxes on dividend income, it means you're making money. It means your investments are working. And while no one likes writing checks to the IRS, the alternative, living off principal and praying it last, is far worse. Moreover, dividend income is often more tax efficient than other forms of retirement income. If you sell stocks for capital gains, you're paying taxes and reducing your principal. If you withdraw from a traditional IRA, you're paying ordinary income tax rates, which can be much higher. Qualified dividends get preferential treatment. It's not perfect, but it's better than most alternatives. The key is to plan for the taxes. Don't spend every dollar of dividend income. Set aside 20 or 25% for taxes. Build that into your budget from day one. This way, April never surprises you. You're never scrambling to cover a tax bill. And here's a subtle point Buffett would appreciate. If you're living off dividends in retirement and you're in a lower tax bracket than you were during your working years, those dividends are being taxed at a lower rate than your salary ever was. So you're actually winning relative to your peak earning years. Think of taxes as rent. You're renting space in the greatest wealth creation machine in human history, the American stock market. The rent is reasonable. Pay it with gratitude and move on. Now let's address the question everyone is really asking: how much do you need? If you want to retire on dividends without touching principal, how big does your portfolio need to be? The answer depends on two things: how much income you need and what yield you can realistically achieve. Let's say you need $50,000 per year to live comfortably, after Social Security, after any pensions, after all other income sources. And let's say you build a diversified portfolio of quality dividend stocks with an average yield of 3%. To generate $50,000 per year at a 3% yield, you'd need a portfolio of about $1.7 million. That sounds like a lot, and it is. But it's also achievable for people who saved consistently, lived below their means, and let compounding work for 3 or 4 decades. If your income need is lower, say $30,000 per year, you'd need about $1 million at a 3% yield. If you're willing to accept a slightly higher yield, say 4%, those numbers drop proportionally. But remember, chasing yield often means sacrificing quality. A 4% yield is achievable with great companies. A 6% yield probably isn't. And here's the beautiful part. Once you hit your number, the stress disappears. You're not checking the market every day. You're not worrying about sequence of returns risk. You're just collecting your dividends, paying your bills, and living your life. The portfolio becomes invisible. It's just there, working like a silent partner who never complains and never quits. Buffett also understood something most financial advisors won't tell you. You don't need a perfect portfolio. You need a good enough portfolio that you won't sabotage. Most retirees fail not because they picked the wrong stocks, but because they couldn't stay the course. They got scared. They got greedy. They listened to someone promising better returns with crypto or gold or some new strategy that sounded sophisticated but was really just gambling. The beauty of a dividend portfolio is its simplicity. You own businesses. They pay you. That's it. There's no leverage, no derivatives, no market timing, no magic. It's transparent. It's boring. And boring is exactly what you need at 65. Buffett's desk at Berkshire Hathaway is famously empty. No computers, no Bloomberg terminals, no real-time market feeds, just some annual reports and a telephone. Because he didn't need minute-by-minute updates. He owned businesses he understood, businesses that would be valuable in 10 years regardless of what happened tomorrow. You can do the same thing. You don't need to watch CNBC. You don't need to check your portfolio every day. You don't need to react to every headline. You just need to own quality businesses and let them do their job. This is the ultimate luxury of a dividend strategy: indifference to volatility. The market can swing wildly and you can shrug, because your income isn't dependent on the market's mood, it's dependent on business fundamentals. And business fundamentals change slowly. Here's a truth that might sting. Most people who are 65 today waited too long to get serious about this. They spent their 40s and 50s living paycheck to paycheck, even when the paychecks were large. They bought bigger houses, nicer cars, fancier vacations. They told themselves they'd start saving when things calmed down, when the kids were through college, when the promotion came through. And then they woke up at 62 and realized they didn't have enough. Or they had something, but not enough to retire with confidence. So they're still working, still stressed, still hoping the market cooperates for another 5 or 10 years. If that's you, I'm not here to judge. Life is complicated. Medical bills happen. Divorces happen. Job losses happen. Not everyone gets a clean path to retirement. But here's what Buffett would say. It's not too late. Maybe you can't retire at 65 on dividends alone. Maybe you need to work until 70. Maybe you need to scale back your lifestyle. Maybe you need to keep saving aggressively for a few more years. But if you start building a quality dividend portfolio today, in 10 years, you'll have something powerful. In 20 years, you'll have something extraordinary. The dividends will grow. The income will rise. And eventually, you'll reach a point where work is optional, where you can walk away from the job not because you're forced to, but because you're ready. That's dignity. That's freedom. And it's never too late to start building it. Let me tell you what Buffett avoided, because that's just as important as what he did. He avoided debt. Completely. Berkshire Hathaway operated for decades with virtually no debt, and Buffett himself lived debt-free. Not because debt is evil, it's not, but because debt is risk, and in retirement, risk is the enemy. If you're carrying a mortgage, car payments, credit card balances into retirement, you're forcing your portfolio to work harder than it should. You're increasing the income you need, which means you need a bigger portfolio or higher yields or both. Avoid debt. Avoid drama. Avoid dumb risks. He avoided complexity. Buffett never bought anything he didn't understand. No complicated derivatives, no exotic investments, no hedge funds promising alpha. Just businesses. Simple, understandable businesses. If you can't explain your investment to a 12-year-old, you probably shouldn't own it. He avoided trends. Every decade has its hot sector. In the 90s, it was tech. In the 2000s, it was real estate. In the 2010s, it was crypto. Buffett ignored all of it. He stuck with businesses that sold products people needed yesterday, today, and would need tomorrow. Trends fade. Needs endure. And here's the big one. He avoided spending the principal ever for any reason. Because once you start dipping into principal, the game changes. You're no longer investing. You're liquidating. And liquidation has an end point. The math becomes a race. Will you die before the money runs out? That's a terrible way to live. It's stressful, uncertain, undignified. But if you live off dividends and never touch the principal, the math changes. Now you're asking, will the income keep growing? And if you own quality businesses, the answer is almost always yes. The principal becomes a legacy. It's what you pass to your kids or to charity or to causes you care about. It's proof that you lived well, but not wastefully, that you enjoyed your retirement, but left something behind. Let's get philosophical for a moment, because this is about more than money. Living off dividends without touching principal is a mindset. It's a way of thinking about wealth that runs counter to everything modern culture teaches. We're taught to consume, to spend, to upgrade, to extract maximum pleasure from every dollar as quickly as possible. Retirement is sold as a reward, a time to finally indulge, to travel the world, to buy the things you always wanted. And there's nothing wrong with enjoying your retirement. You earned it. You should travel. You should have hobbies. You should spoil your grandkids. But Buffett's philosophy adds a layer of restraint, a recognition that wealth isn't just about you. It's about time. It's about giving your future self options. It's about creating a system that works when you're 75 and when you're 85 and when you're 90. Because here's what no one tells you. The longer you live, the more you'll need that principle. Healthcare gets expensive. Mobility gets expensive. Independence gets expensive. If you've been burning through capital for 20 years, you might not have enough when you really need it. But if you've been living off dividends, the principle is still there, untouched, growing, ready to cover whatever life throws at you. That's not deprivation, that's wisdom. Buffett also had a phrase he used often. Time is the friend of the wonderful business and the enemy of the mediocre one. What he meant was this. Great businesses get better over time. Their brands strengthen, their competitive advantages widen, their cash flow grows. And as a shareholder, you benefit from all of that, not just through stock price appreciation, but through rising dividends. A mediocre business, on the other hand, slowly deteriorates. Competition chips away at margins. Management makes bad decisions. The dividend gets cut or eliminated, and suddenly you're stuck with a stock that's worth less and pays less. This is why quality matters so much in a retirement dividend portfolio. You're not just buying stocks. You're buying partners for the next 30 years. And you need partners that get stronger, not weaker, as time passes. Think of it like choosing a spouse. You're not looking for someone who's exciting right now but might self-destruct in a decade. You're looking for someone reliable, stable, trustworthy. Someone who'll be there when things get hard. That's what great dividend stocks are, reliable partners in an unreliable world. And here's something Buffett understood that most retirees miss. You're not just managing money. You're managing emotions. The biggest threat to your retirement isn't market risk or inflation or taxes. It's your own psychology, your fear, your impatience, your envy when your neighbor brags about his latest crypto gains. This is why Buffett built systems that removed emotion from the equation. He didn't check stock prices. He didn't react to news. He just owned great businesses and collected his cash. You can do the same. Set up automatic dividend reinvestment in the early years. Set up automatic transfers from your brokerage to your checking account in the later years. Make the system automatic so you're not constantly making decisions. Because every decision is an opportunity to make a mistake. Every time you log into your account, you might be tempted to sell something or buy something or change something, and most of the time, doing nothing would be better. Automate. Simplify. Remove yourself from the equation as much as possible. That's how you win the long game. Let's talk about legacy for a moment, because it matters more than most people admit. If you successfully live off dividends without touching principal, something remarkable happens. You die with more money than you retired with. Your portfolio, assuming decent dividend growth, will have compounded even while paying you. The principal will be larger at 90 than it was at 65. And that principal becomes your legacy. Now, maybe you don't care about leaving money behind. Maybe you subscribe to the die with zero philosophy. Spend it all, enjoy every dollar, leave nothing on the table. That's a valid choice. But it's not Buffett's choice. And it's not the choice of most people who build real wealth. Because wealth isn't just about you. It's about giving your kids a head start. It's about funding causes you believe in. It's about being remembered, not just for what you enjoyed, but for what you enabled in others. Buffett himself is giving away nearly his entire fortune, not because he needs the tax break, not because he's trying to buy his way into heaven, but because he recognizes that capital has power, power to educate, to heal, to lift people out of poverty. And he wants that power deployed wisely. You don't need to be a billionaire to think this way. Even a modest estate, $500,000, $1 million, $2 million, can change lives if directed thoughtfully. And here's the beautiful irony. The discipline required to live off dividends without touching principal is the same discipline that builds a meaningful legacy. You can't do one without the other. So, where does this leave us? If you're 50, 60, 70 years old and you're wondering whether this approach can work for you, the answer is yes. But it requires a few things. It requires honesty about where you are. If you don't have enough saved, admit it. If you've been living beyond your means, admit it. You can't fix problems you won't acknowledge. It requires discipline. You'll need to cut expenses, avoid debt, and save aggressively in the years you have left. No more excuses. No more next year. The time is now. It requires patience. You can't build a dividend portfolio overnight. It takes years for the compounding to work, for the dividends to grow, for the income to become meaningful. But if you start today and stick with it, in 10 years, you'll be amazed at what you've built, and it requires emotional fortitude. You'll live through crashes. You'll watch your account balance swing wildly. You'll be tempted to panic, to sell, to do something stupid. Don't. Just keep collecting your dividends and trust the process. Warren Buffett's genius wasn't that he was smarter than everyone else. It's that he was more patient, more disciplined, more willing to endure short-term discomfort for long-term gain. You can do the same. You don't need to be a genius. You don't need perfect timing. You just need to own quality businesses, reinvest when you can, live off the income when you must, and never touch the principal. That's the formula. Simple, but not easy. Here's what I want you to take from this. Retirement isn't about having the biggest account balance. It's about having enough income to live with dignity and enough peace to sleep at night. Buffett figured out how to create that peace. He built portfolios that paid him to do nothing. He owned businesses that survived everything the world threw at them. He never had to worry about running out because his income kept growing faster than his expenses. You can do this too. Not exactly the way Buffett did. You're not managing $100 billion, but you can apply the same principles on a smaller scale. Own quality businesses that generate cash. Diversify enough to protect yourself, but not so much that you lose focus. Reinvest dividends when you can. Live off them when you must. And never ever touch the principal unless you absolutely have to. That's how you retire with confidence. That's how you sleep well. That's how you build something that outlasts you. And here's the final truth. This isn't just an investment strategy. It's a life strategy. It's about living below your means so you can live above your fears. It's about being patient in a world that worships speed. It's about valuing stability over excitement, compounding over gambling, peace over performance. These are old-fashioned ideas. Buffett would be the first to admit that. But old-fashioned doesn't mean wrong. In fact, when it comes to money and retirement, old-fashioned is usually right. Because the fundamentals of wealth haven't changed in 100 years. Spend less than you earn. Save consistently. Own great businesses. Let compounding work. Don't panic. Don't get greedy. Stay the course. That's it. That's the whole game. So here we are at the end of this conversation, and I want to leave you with this thought. You've worked your entire adult life, 40 years, maybe 50. You've earned your money through your labor, your skill, your sacrifice. And now, in this final chapter, it's time for your money to work for you, not through speculation, not through hoping the market goes up, but through the quiet, steady accumulation of dividend income from businesses that have survived wars, recessions, pandemics, and every flavor of chaos the world can produce. This is the gift Buffett gave us, a roadmap for retiring with dignity, not promises of quick riches, not hype or complexity, just the simple, powerful idea that if you own great businesses and let them pay you, you can live the rest of your life without fear. That's freedom, real freedom, and it's available to anyone willing to be patient, disciplined, and rational. The rational retiree doesn't chase returns, doesn't panic in crashes, doesn't spend the principal. The rational retiree builds a portfolio that pays them to sleep well. And then they do exactly that. They sleep well, live well, and leave something behind. That's the life Buffett understood, and it's the life available to you. All you have to do is start.